you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Welcome to the Morningstar series, Why Should I Invest With You? I'm Holly Cook, and joining me today is Gervais Williams. He's manager of the Miton UK Smaller Companies Fund. Gervais, thanks very much for joining me today. So you've just published a book which has got a rather interesting title that I think will raise a bit of controversy, and in particular you're asking why will you believe AIM will be one of the world's best markets after the credit boom. Now, if we look at the AIM markets, obviously they haven't done particularly well for multiple years, and this year in particular down something like 14%, I think. What is fueling this idea, this belief that you have that AIM is going to be the best world market?
Yes, it's very interesting because I think what we're looking at here is that market trends have changed. We've sort of seen that the fundamental economic trends have been changing anyway. You know, whereas world growth was very buoyant up to recently, more recently the headlines now have very much been of world growth stalling. And I think that's leading to big companies really struggling to get top line growth, struggling to get dividend growth. And of course, small companies won't find it easy, but they find it easier. They can buck the economic trend. And it's the availability of smallness in the AIM market, which I think is going to come to dominate. And as that does so, investment flows into the small companies, being illiquid, are going to drive this market up considerably over future years.
So you're not saying that this is going to be a sort of short-term rebound. You do think this will be a long-lasting story of growth? Yes,
I mean, we're talking about a super cycle, something which lasts decades and which will actually lead to substantial investment in this area. So institutions typically in small micro, I'm not talking about small mid, I'm talking about small micro, probably have 1% or near 0%. And if you go back to the 70s and the 60s, when the market was very tough and the economy was not much better, they typically had 10 or 15% in the very smallest companies. And that's because they can buck the economic trend, they can grow dividends, and it's that rising dividend flow which is going to become amazingly pushy in terms of driving these markets higher.
So do you believe that sort of today's AIM stocks will be tomorrow's large caps, as it were?
Yeah, certainly. I mean, I think we've got to be very clear, though. A lot of the companies which are sort of one-off stocks, which are hoping to get lucky on commodity prices or perhaps solving cancer, there is a place for those. But actually, the real driver of this return is going to be the everyday businesses doing everyday sales in manufacturing or perhaps in services, driving up their cash flow, driving up the ability to pay dividends, and driving up that opportunity for shareholders to make a compounded return with income growing.
This is an area that traditionally does inherently have an awful lot of risk. It's a volatile area of the market. Are there particular characteristics that you would look for when looking for an AIM stock that you think is going to be able to deliver those sort of returns?
Yes, I mean, individual share prices are quite volatile. You're absolutely right. And that's because they don't tend to trade so much. They're small, they're illiquid. But of course, what you do have at this end of the market is many companies which have very strong balance sheets, net cash or very modest net debt. They've got ability to withstand uncertainty in a way perhaps that some of the very largest companies with a lot of corporate debt are probably a little bit more vulnerable. So actually, if you can get individual companies which have lots of assets, tangible assets, cash, lots of sales, which can then get more commercial in producing a better return out of those, you can see these companies really growing so considerably over time. And actually, in a risk-adjusted basis, I think that a portfolio of these kind of companies is actually going to come out as actually relatively low risk compared with the return you get.
So let me try to sort of pin you down on time frames. I mean, so looking back, I think you were saying that from sort of the 90s that we haven't really seen an awful lot of growth in this area as a whole, but you're now saying you believe this is going to be a particularly strong market. I mean, over what sort of time frame? 3, 5, 10 years? I mean, what sort of horizon do you think an AIM investor needs to have?
Yes, I mean, if we look back over the last 20, 25 years, I mean, AIM stocks have grown. Big companies, small companies, international companies, emerging market companies. There's been growth universal. It's not been difficult to find growth. But actually what we're really saying is that returns have not been distinctive because growth has been so plentiful. It's the fact that small companies have the distinctive advantage of being able to grow when large companies don't grow, when the economy's flat, that is the distinctive feature which is going to become more prominent now. So looking at the time frame, I think it's already started. I mean, if you look at actually the AIM market over the last 18 months, it has risen, not as well as the small cap market, but it's on its way. It's been dominated by companies moving the other way. Some of the commodity and mining stocks have come down in the short term. They're becoming less important as a percentage advantage. The new companies coming to market are decent income generators, growing businesses, more everyday aspects of the business. So that's already happened. It'll be a zig and zag on the way up, but absolutely, if you look at dividend growth coming from the bottom end of the market, it's superior to the main market now. That is the defining feature in the 70s and the 60s, and that is why they outperformed on average at the bottom end around 4% per year for 2 decades. So time frame, I don't think you need to wait. It's time to get in now.
Well, thank you, Gervais, very much for your summary of insights there. I'll be reading the book to find out more.
Thank you very much.
For Morningstar, I'm Holly Cook. Thanks for watching.